Last time we spoke, it was earlier this year, and we were talking about the credit markets, and I always love to talk to you about the credit markets. You were forecasting a train wreck sometime this year, third or fourth quarter. We've had at least one train wreck, but it involved an actual train, unfortunately. As far as the credit markets go, or high yield, the defaults continue to come in. So Welcome to the Power Market Report. I'm Albert Liu, joined once again by Rick Rule. He's the chairman of Sprott USA. Rick, thanks for joining me once again. How are you?
Albert, it's always a pleasure. I'm doing fine, thank you.
Last time we spoke, it was earlier this year, and we were talking about the credit markets, and I always love to talk to you about the credit markets. You were forecasting a train wreck sometime this year, third or fourth quarter. We've had at least one train wreck, but it involved an actual train, unfortunately. As far as the credit markets go, or high yield, the defaults continue to come in. So I think we were at about 100 in July, and I just saw that we've passed 130. That's, I think, as of September or October. So we've passed the 2015 total. But I don't think this is the event that you had in mind. So can you update us on what you're seeing in the credit markets? And incidentally, most of those, I think it's 70% or more, are coming from the energy sector. So can you update us on what you see going on in the credit markets?
Absolutely, Albert. Once again, my track record is consistent. I was early in terms of my forecast. The truth is that the energy credit market has stayed fairly strong relative to where I thought it would be. Buoyed, I think, by the sort of $50 quote in West Texas Intermediate and the continued demand for yield among investors. I still believe that with in excess of $3 trillion in energy credit outstanding to publicly traded oil and gas companies, most of it issued when oil prices were in the $90 range, that even $50 isn't sufficient to skate these credits on side. But the truth is that time will tell. It's difficult for me, looking at the impairments that are happening in the senior revolving credit side of the credit space, to believe that the subordinated debt markets, the junk bonds, will continue to go unscathed. But this, thus far, I have to quote from my other favorite credit analyst, Patsy Cline, and say I was so wrong.
Well, when you look at the sort of the assumptions that led to the conclusion and pick them apart, what was the loose chain in the link? Did you not expect near $50 oil? Were those credit revolvers renegotiated more leniently than you expected? What exactly happened?
I haven't seen any real change. I'm certainly hearing from the smaller issuers about the banks becoming much less generous in the senior revolving facilities. We just haven't seen carnage in the system to the extent that I would have expected by now. I certainly think that the increase in the oil price from $40 to $50 and the suggestions by both the Saudis and the Iranians that they would, quote, play ball with regards to restricting output has given both the bankers and the issuers hope. I continue to believe that that's misplaced hope, both because I don't believe that a $50 quote is sufficient to generate enough cash to skate those credits on side, and also because I don't believe that the Saudis and the Iranians will play ball with each other. I don't see on a global basis sufficient demand to bolster the oil price quote. I noticed that the Russians are at an all-time high production number. There was 4.5 million barrels a day being produced and sold by Iraq fairly recently. And if we had any cessation of hostilities in Libya, there's about 2 million barrels of oil in Libya that could come onto the world market. So it doesn't appear to me like 2017 is going to be a particularly buoyant time for the oil price, absent a global economic recovery. And while I'm not an economist by any stretch of the imagination, I don't see anything resembling a global recovery that would give me cause to feel good about the oil quote, or in fact, any material tied to industrial activity.
Yeah, I just spoke with economist John Williams. He doesn't see a recovery coming either. I want to talk a little bit about ExxonMobil. They missed earnings just recently, and it's all over. But one thing that stuck out when I read the news was the downstream business. They mentioned that there was a lot of margin compression there. And that reminded me of a note that I saw out of Sprott. One of your fund managers was talking about oil service companies have been heavily discounting their fees. And so if and when the oil price eventually recovers, aren't there a lot of mouths to feed in that chain?
Well, there are. In terms of the junk debt thesis, that's fairly unimportant. But the truth is that in particular, the Exxon report that you mentioned is troubling. The global integrated oil and gas business has traditionally been a great business, to the extent that when oil prices are strong, they get margin in the upstream. To the extent that the oil prices are weak, refined product prices are stickier. They move down less rapidly than the feedstock price moves down, so that margins can occur in the downstream rather than the upstream activity. To see margins weak across the value chain is distressing, and it sends, I think, a distressing message with regards to the global economy. Now, the truth is, for the purposes of our discussion, Albert, Exxon is anything but a junk credit. It doesn't play into our discussion. The discussion that we would be having are in the sub-billion-dollar market cap arena, and mostly confined to north of the border. But what your Exxon note does give us pause to consider is a business that's been really impervious to previous shocks, feeling pain throughout the supply chain, which is interesting.
Okay. You think this is the inevitable consequence of all of the development that happened in the recent years past?
I wish I could answer that question with a straight face, but I have no earthly idea. My my analytical track record in downstream is unblemished by success, so I'll leave that to smarter people than myself.
Okay. Let's talk about a related topic, and that is liquidity and perceived liquidity, not just in high yield, but in other assets. There are a lot of illiquid assets now that trade in ETF and mutual fund form. I'm thinking about UK real estate as an example, but also high yield. What are your feelings on that as far as perhaps that being a trigger point for a problem?
Albert, I think you've put your finger on the $64 trillion question. It's amazing how inflation changes the perception. Remember, that used to be the $64 million question? At any rate, I think liquidity is the issue, and I think it's an issue in two different ways. The first instance is that nobody worries about the solvency of the system as long as there's sufficient liquidity. If there's enough cash rolling around in various systems, be it the undercapitalized banking sector, where the solvency could be an issue with regards to, as an example, derivatives liability, or looking differently, the solvency of the pension system, or in fact the solvency of governments. Solvency is less of an issue in investors' mind if there's plenty of liquidity. The truth is that somebody that has a $100,000 net worth that owes $1 million may be unconcerned about their solvency if they have $10,000 or $15,000 cash in their pockets. I believe that cash, liquidity, is in fact the soporific that keeps people from being concerned about solvency. I think liquidity is the savior and liquidity is the curse all at once. The other liquidity that we need to address is, as you suggest, the fact that liquidity in equity and debt markets is increasingly being provided by exchange traded funds or ETFs. Everybody likes this form of liquidity when the ETFs are growing and when they're able to buy equities or buy debt and pull them up. But the truth is, when these ETFs unwind on occasion, liquidity becomes a huge problem. An example would be, again, as you suggest, and topically to energy, many of the junk bond markets are driven by high yield ETFs, very popular with investors because they can yield 6.5, sometimes 7%, seemingly safe yields when the avoided yield from a certificate of deposit might be 50 basis points. The difficulty is that these are extremely large funds, $3 and $4 billion funds, and many of their assets are $75 or $100 million issuances, where the ETF might own 15 or 20% of the entire issuance. A situation where the contagion begins to unfold, either in high yield debt generally or in energy high yield debt, could become very problematic. If the ETFs, as an example, were to begin to experience disintermediation, people redeeming funds at the ETF, at the same time that there were liquidity concerns with regards to the constituents of the ETF, those aforementioned $100 million issuances, then the managers of the ETF, having to sell assets to fund redemptions, would come face to face with a concept that we call owl bonds. An owl bond is where you go to call your broker saying, please sell, and your broker says, to who? To who? And my suspicion is that we may run into that circumstance next year. I've certainly seen it before in tight equity classes, and it wouldn't surprise me at all to see it in tight debt classes.
Rick, do you have a feeling on how something like that will play out? Because in the case of Brexit with the property trust, we saw different funds handle it in different ways. So some of them had sufficient liquidity, it wasn't a problem. Others halted redemptions. And the third class provided limited liquidity at discounts. What do you think, well, I'll ask you, what is the preferred method in your view, but what do you think will actually happen?
Well, it depends on what hat I have on, Albert. If I have on my humanitarian hat, that seldom fits, probably the gated liquidity option would be the best, where the ETFs, rather than presiding over total pandemonium, blocked their shareholders from gaining liquidity and thereby preserved the market. A much more common hat for me, Albert, is the opportunistic hat. And in that particular case, what I would prefer is that the markets absolutely blew themselves up. Right. And we were able to sort through the flotsam and the jetsam in energy credit markets and buy some illiquid instruments that were in fact solvent, bonds where we understood that the companies themselves could survive the credit, and where we were able to buy decent 7% credits at 40 or 50 cents on the dollar, achieving for ourselves 14 or 15% running yields, and of course accreting the discount to par, up to par over the remaining life of the instrument. Remember that the worst piece of debt on any individual balance sheet is better than the best piece of equity. And if you buy a bond at 50% with 4 years to run, in addition to getting the 15% running yield, you get the difference between 50 and 100 over the remaining 4-year life of the bond. So in the context of the question that you asked me, Albert, as a humanitarian, of course, I hope that the situation is managed. As a investor, I hope that the situation is completely tumultuous and out of control.
From where you are, do you see savvy and opportunistic money managers already raising money for that purpose?
Sadly, yes. We do see some competition on the horizon. It's an interesting conundrum because most of the people who have access to large amounts of institutional money are going to play in the larger junk bond issuances. the more liquid junk bond issuances. The saving grace for us is that we have about a 30 company shopping list that's in the smaller end of the spectrum. And by the way, mostly north of the border, mostly traded either in Toronto or on London. The reason that we've chosen the non-US debt side of the business is A, because the market is smaller, more opaque, and more illiquid, and also because bankruptcy laws, the rights with regards to creditors, are much better established and much more according to the rule of law, both in Canada and Great Britain than they are in the United States.
Okay, I want to move on. I've heard you recently, when asked, choose to be reticent on the U.S. election, and by reticent I mean smart. However, today is November 1st. We're a week away. Something is going to change next week. If you're me and you're cynically optimistic, you have one less person to worry about after next week. But I'd like to know, are you personally doing anything in terms of the money, of the portfolio, to prepare yourself for the shock either way that'll come next week?
Well, not for money that I manage for others. With regards to the money that I manage for myself, the outcome of the upcoming election is an unthinkable catastrophe no matter who wins. It's difficult for me to believe that a country like ours could nominate two people, both of whom would cause me to be nostalgic for Obama, somebody who I detest. And so what I've done is I've put in place a little position betting on an increase in the VIX, in the volatility. I suspect that if Trump were to win, that there would be widespread fear through most of the populace. I suspect should Clinton win, there would be widespread fear through most of the populace. And I suspect that either candidate's victory would be disquieting to a lot of people. And I also believe that the VIX itself is quiescent, not as a consequence of the economic outlook, but rather as a consequence of the liquidity in the system. And the liquidity is partly a function of confidence. Anything that shakes confidence could shake liquidity, and I think that would send the VIX above 20. Now, this is a bet that's way outside my circle of competence. It has nothing to do with credit analysis. It has nothing to do with natural resources. It probably has to do more with my disgust with regards to the political system than it has to do with the actual economic consequence of the election of either candidate. Warren Buffett, who is, let's be charitable and say, arguably a better investor than I, has said that although he prefers Clinton, he believes that the American economy is strong enough to withstand either candidate. And I suspect he's correct.
Yeah, and I like the way you put it, actually. You said American society is stronger, strong enough to survive either one. Before, I guess, the other day, when news of these additional emails came out, people were feeling like the market had priced in a Hillary Clinton victory. Now the whole thing is in the air. Do you agree? Do you feel like now her victory is no longer priced in?
I don't. I believe that Hillary supporters don't care about emails. And I believe that Trump supporters don't care about his untoward actions towards women. I think that support on either side is A, irrational, and B, tribal. If Trump is going to have a chance, I think it's because there's a substantial number of people who inexplicably are actually for him. And they may show up to vote, both as a consequence of the fact that they despise Hillary and for some reason haven't found a way to despise him. I think that more people believe that Hillary's lies are palatable to themselves. But I think that her support, although it's spread over a larger number of people, is less enthusiastic than his support. So as an example, if for some reason there was a lot of rain next week and people decided just not to go out to vote, I suspect that Trump might prevail because his constituency is more motivated than her constituency. That being said, I suspect that she will win because the type of lies that she tells panders to a greater percentage of the electorate than the type of lies that Trump sells.
Very good. You know, one of my concerns is, say that does happen, but the other side doesn't accept the result. Then you could have an enormous VIX spike, don't you think?
Oh, I think that'd be a lot of fun. Anything that destabilizes a political system that could generate Trump, Bush, Ryan, Clinton, Saunders. There's not really a lot worth saving from my point of view. And anything that destabilized it would be at once, I think, cathartic and amusing. Certainly more amusing than the presidency of either of those candidates.
Okay, Rick, we're almost out of time here. I want to end with a pop quiz. I want to ask you, what do you think has performed better in 2016? Uranium or avocados?
Well, I've certainly consumed more avocados, so I would suspect avocados. I'll hit you with the response quiz after you tell me how wrong I was.
There's a deep shortage right now. They're reporting in some places prices have tripled. So it's been a good trade if you know how to trade it. But I would want to present a thesis reasoning the way you've taught me to reason in language that will be familiar to people who follow you. And that is, when you're watching Super Bowl 51 and the chip enters the bowl, will there be guacamole in that bowl?
Or yellow cake? Yeah, that's certainly interesting. I hope for a lot of the voters that it's the latter rather than the former. Now let me give you a quiz.
All right.
What was the best performing mined commodity in 2016?
2016.
So far in 2016.
You know, I don't have my pulse on it, but it's going to be something counterintuitive, right? It's going to be like copper
Certainly.
or coal or something hated.
You got there. It's met coal, metallurgical coal, up from $80 a ton to $214 a ton. That commodity that everybody hated and predicted the demise of has tripled in 2016.
Yeah, and people couldn't hate it more, but I guess that's the way the market goes. Now, my question to you is: Have you made money on that?
I have, in fact, a little junior, U.S.-based junior Corsa coal. We saved it, I think, from oblivion with a financing earlier in the year, thinking that they had a durable competitive advantage. That advantage was that they shipped coal from Pennsylvania to Pennsylvania and Ohio. So they had a freight advantage over their competitors. There's a lot I don't know about the coal business, but I know that it's cheaper to ship coal from Pennsylvania to Pennsylvania than it is to ship it from South Africa or Australia to Pennsylvania. I'd like to say that I knew the coal price was going to triple. I know that I couldn't say that to you and have you keep a straight face no matter how hard you tried.
Right.
So the truth is that I bought the stock for the right reason, and I got bailed out for a better reason, but one that I wasn't the author of.
Fantastic. Okay, Rick, at this point, we have to leave it. Thank you very much for coming once again. People can find you at sprottglobal.com, and while there, they can subscribe to your highly popular Sprott's Thoughts newsletters. Any final thoughts?
Well, one final thought for your viewers, to the extent that they're interested in natural resources. This was brought home to me in the New Orleans Investment Conference. There's about 200 hours of free instructional material at the Sprott Global website. People who want to learn more about the natural resources sector, whether or not they have the good sense to become Sprott customers, can avail themselves of 200 hours of high-quality instruction material for free on the Sprott website. And I would encourage people to do just that.
I would second that. I've been digging in there recently, actually, for the benefit of the investment group I host here, and we've been having a lot of fun, so please definitely check that out. Thank you, Rick. Let's talk again soon.
Always a pleasure, Albert. Thank you.
Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.